Welcome to TalkTickers. We're here to give you the inside track on key earnings calls.
That's right. And today we're diving into Forestar's latest call. They're a pretty significant name in lot development.
Yeah, absolutely. Our goal here is simple: cut through the noise and give you the essential takeaways from their Q2 results.
Okay, let's jump right in. Headline numbers. Net income landed at $31.6 million.
Which works out to, what, 62 cents per diluted share?
Exactly, 62 cents per diluted share. And revenues hit $351 million.
Okay, $351 million. How does that compare?
That's a pretty solid 5% increase compared to the same quarter last year.
Interesting. And what about actual lots sold? That's their core business.
Right. They sold 3,411 lots. Now that's up 4% year over year, which is, okay. Well, compared to the sequential number, yeah. Sequentially, quarter over quarter, sales jumped 46%.
Wow, 46% from Q1. That's a big leap. What does that signal, do you think?
It suggests things really picked up coming out of the winter months. A seasonal effect, maybe, but a strong one.
Okay. But what really stood out to me was the future pipeline, the lots under contract.
Oh, absolutely. That number is impressive. Lots under contract to sell surged 41% year over year.
41%. How many lots is that?
That's 25,400 lots they have contracts for.
25,000? That sounds like a huge amount.
It is. It represents about 37% of all the lots they currently own.
Yeah.
And in dollar terms, you're looking at a backlog of $2.3 billion in future revenue.
2.3 billion. Okay, so that provides some real visibility down the road. Investors like that, right?
Definitely. It gives a strong sense of future earnings potential.
So selling well now in a big pipeline, how's their overall financial health looking? Balance sheet stuff.
They seem to be shoring things up. They mentioned liquidity is up to around $800 million.
$800 million in, ready cash.
Pretty much, yeah. And they also did some refinancing back in March, pushed out their debt maturities.
Smart move, extending the debt runway in this kind of rate environment.
For sure. No senior notes due until May 2026 now.
And are they still growing, expanding their footprint?
Oh, yeah. Still in growth mode. Mm-hmm. They entered 10 new markets over the past year.
10 new markets.
And that increased their total community count by 21%. A lot of that expansion often follows their biggest customer.
Dr. Horton, I assume. We'll definitely need to talk more about that relationship.
We will. It's key.
Okay, so quick recap. Revenue up, huge backlog, expanding, stronger balance sheet. But let's dig into the profitability numbers a bit deeper. Gross profit margin.
Right. The gross margin for the quarter was 22.6%.
Okay. How does that compare to last year?
It's down from 24.9% in the prior year's quarter.
Down? Okay. Should we be worried about that compression?
Well, you need a bit of context there. Last year's number, the 24.9%, apparently included some non-recurring high-margin items, one-offs.
Okay. So not a clean comparison then.
Not exactly. If you adjust for those one-time things, management said last year's comparable margin was actually around 22.5%.
Got it. So 22.6% this year versus an adjusted 22.5% last year. That sounds pretty stable, actually.
Exactly. On an adjusted basis, it's very comparable, much less concerning.
Okay, that makes more sense. What about pre-tax income then?
Pre-tax income was $40.7 million. That gives a pre-tax profit margin of 11.6%.
And how does that compare?
That is lower than the 17.6% they posted last year.
Okay, why the bigger drop there if gross margins were stable on an adjusted basis?
It was mainly two things. First, the absence of those one-off high-margin items we just talked about. And second, a bit less SG&A leverage this quarter.
SG&A, selling general and administrative costs. Less leverage means costs grew faster than revenue.
Sort of. Or the fixed cost base was spread over slightly less margin dollars this quarter compared to last year's boosted numbers. Think of it as getting less bang for your operating cost buck compared to that unusually high prior year quarter.
Right. Okay. And the average price per lot they sold?
Came in at $101,700.
But I guess that number jumps around a lot depending on where they're selling. California lots versus Texas lots, for instance.
Precisely. Geographic mix, lot size mix. All that will cause the average sales price, or ASP, to fluctuate quarter by quarter. You can't read too much into one quarter's ASP.
Okay. Now, you mentioned SG&A. Those expenses were up quite a bit, weren't they?
They were. Up 32% year over year, hitting $38.4 million.
32%? What's driving such a big increase?
It's almost entirely headcount. Their employee count grew by 29% over the year. They're up to 440 employees now.
Wow. And that hiring is directly tied to the expansion, the new markets and communities.
That's the explanation. building out the teams needed to support that larger operational footprint.
So as a percentage of revenue, SG&A must have climbed.
It did. It was 10.9% of revenue this quarter compared to 8.7% last year.
So they're investing heavily now. Do they expect that percentage to moderate? To get more efficient?
Yes. They specifically said they anticipate that percentage will decrease in the second half of the year.
How? Just by revenue catching up?
Essentially, yeah. As revenue grows from these expanded operations, those SG&A costs should become a smaller piece of the pie. Better leverage, as they call it.
Makes sense. Okay, shifting gears a bit, what about the broader market? Did they comment on the selling environment?
They did. They noted the spring selling season started a bit slower than they might have hoped.
Slower? Why? Affordability still biting.
That seems to be the main thing. Affordability constraints, higher mortgage rates, maybe some wobbles in consumer confidence. The usual suspects.
Are builders doing anything to counteract that?
Yeah, they mentioned that mortgage rate buy-down incentives from the home builders are helping, trying to bridge that affordability gap for buyers.
Okay. What about on the supply side? Getting the lots built? Any issues with labor or materials?
Actually, that sounded like a positive. They said availability of contractors and materials is good right now.
Oh, that is good news. Costs stabilizing too.
Land development costs have apparently stabilized, and they're even seeing cycle times improve, getting projects done faster.
Any bottlenecks?
The only thing they mentioned was some ongoing delays with governmental approvals, permitting, zoning, that sort of thing. Sounds like that's still a bit sticky.
Always something, isn't it? Okay, let's talk about Dr. Horton again. You said they're key. How important is that relationship?
Hugely important. Horton is their largest customer by a wide margin.
And Forestar has a specific goal related to them.
They do. Their stated ambition is for 1 out of every 3 homes Dr. Horton builds to be on a Forestar lot.
1 in 3. Where are they now on that?
Well, over the last year, about 15% of Horton's housing starts were on Forestar lots. And just in this past quarter, 22% of the finished lots Horton bought were from Forestar.
Okay, so 15% over a year, 22% in the quarter. Still ways to go to hit that 33% target, but definitely significant.
Significant and trending up. There's clear room to grow that share.
Are they selling only to Horton or diversifying?
No, definitely diversifying too. In Q2, about 27% of their deliveries went to other customers.
27%. How many lots was that?
That was 910 lots sold to other builders and intermediaries.
Intermediaries? Like who?
Well, interestingly, that included 362 lots sold to what they called a lot banker.
A lot banker? What's that?
It's essentially an entity that buys lots, holds them, and then resells them. In this specific case, the lot banker apparently intends to sell those lots on to Dr. Horton later.
So an indirect sale to Horton almost. Why do that?
Good question. Maybe timing, maybe financing?
Yeah.
The call didn't really elaborate. But Forestar also sold directly to 10 other home builders during the quarter.
Any new relationships there?
Yep, 2 of those 10 were brand new customers for them, so definitely broadening the base.
Okay, let's talk land inventory. How many lots do they control overall?
Their total lot position grew 10% year over year. They now control 105,900 lots.
Wow, and how much of that is owned versus option?
About 65% is owned outright. The other 35% is controlled through purchase agreements or options.
And how many are ready to build on right now? Finished lots?
At the end of the quarter, they had 9,500 owned lots that were fully finished. And they noted most of those are already under contract to be sold.
So not a lot of finished inventory just sitting around. Sounds like they manage that pretty tightly.
Very tightly. Their goal is to maintain about a 3 to 4 year supply of owned land and lots, and they actively manage the pace of development to match market demand.
Makes sense. Do they have specific financial hurdles for new projects, return targets?
They do. Their underwriting criteria haven't changed. They're looking for a minimum 15% pre-tax return on average inventory invested in a project.
15% pre-tax ROAI.
Okay.
Anything else?
Yeah, they also want to get their initial cash investment back within 36 months.
Got it. Disciplined approach. How much did they actually spend on land and development in the quarter?
Investment was around $340 million. That's pretty flat compared to last year.
And how did that spending break down between buying new land versus developing existing land?
About 21% went to acquiring new land, and the bulk, 79%, went towards development activities.
So heavier on development, lighter on new acquisitions right now.
Seems that way. Maybe a touch more cautious on buying raw land at the moment. For the full fiscal year 2025, they're now projecting total investment of around $1.9 billion.
$1.9 billion, but they said that depends on market conditions.
Exactly. Subject to change based on how things play out.
Okay, let's quickly revisit the balance sheet health. You mentioned liquidity was good. Recap the key stats.
Sure, liquidity at quarter end was $792 million. The refinancing pushed debt maturities out, none before May 2026. Their net debt to capital ratio was 29.8%.
29.8%. That sounds pretty manageable.
Generally considered quite reasonable, yes.
Yeah.
Stockholders' equity is now $1.6 billion, and book value per share grew 11% year over year to $32.36.
Solid numbers. Did they update their outlook for the full year guidance?
They did. They adjusted it slightly. They now expect to deliver between 15,000 and 15,500 lots for the full fiscal year.
15 to 15.5. And revenue.
Revenue guidance is now $1.5 billion to $1.55 billion.
So a slight trim to the outlook. Is that purely because of the slower spring start?
That's how they framed it, reflecting the impact of that slower start on the timing of lot deliveries for the rest of the year.
But overall, the tone sounded still fairly confident, despite the adjustment.
I'd say so. Management really emphasized their flexibility, their ability to adjust to market shifts. And they seem quite confident about long-term demand fundamentals and their ability to keep gaining market share.
Especially with finished lots being so scarce in many places, right?
Exactly. That constrained supply environment really plays to their strengths as a large-scale developer.
What are they seeing from raw land sellers? Are prices coming down?
Not really on price, it sounds like. They mentioned seeing more flexibility from sellers on the terms of deals, but not significant movement on the actual price tags. Sellers are still holding firm on valuations, mostly.
Interesting. And those lot banker deals, do they get the same economics as a direct sale?
Yes. They clarified that when a home builder assigns a contract to a lot banker, Forestar's pricing and expected returns remain the same. It's just a different counterparty for that specific transaction.
Okay. And just to circle back on SG&A, it really sounds like that increase is purely about past hiring, catching up, setting the stage for future growth, not ongoing runaway costs.
That seems to be the message. It was driven by prior headcount growth for expansion. They expect headcount to be pretty flat for the rest of the year.
Which should lead to that improving leverage later on as revenue hopefully grows.
That's the plan. More efficient operations as they scale.
Did they mention any other potential cost pressures, like tariffs? Any impact there?
They were asked about potential tariffs. Management basically said it's too early to tell what the impact on land development costs might be. Something they're watching, but no clear picture yet.
Okay. And regionally, any variations? Some markets stronger or weaker than others?
Yeah, a little bit of color there. They noted some relative weakness or softening in Florida.
Florida softening. What about Texas?
Texas showing less weakness, apparently. And they called out strength in other markets like Las Vegas and the Carolinas.
So a mixed bag geographically.
Seems so. And they also suggested the overall slowdown they are seeing is less about fundamental demand dropping off a cliff and more about the pace of bulk lot takedowns by builders. Sort of returning to a more normal pre-COVID cadence rather than the frantic pace we saw before.
Right, a normalization rather than a collapse. Okay. And the slightly lower guidance for land development spending, is that just caution or do they feel they have enough land already?
Probably a bit of both. Partly reacting to current conditions, being prudent, but also they emphasize they have a strong existing lot position.
So they have flexibility. They can dial spending up or down relatively easily.
That's the idea. They can adjust based on shifts in demand.
It really sounds like management sees this environment, maybe counterintuitively, as an opportunity for Forestar.
I think that's a fair assessment. They seem to believe they can consolidate market share right now, both by deepening that critical relationship with Dr. Horton and also potentially picking up business from other, maybe smaller, builders who are finding it harder to secure their own lot supply.
Especially given Horton's scale and Forestar's ability to deliver for them.
Exactly. They sound very optimistic about continuing to grow their share of Horton's business, largely because the overall supply of finished lots remains tight. Horton needs reliable suppliers.
Did anyone ask about potential federal deregulation? Could that suddenly flood the market with lots?
It came up. The answer was basically the impact is unclear right now. Too uncertain to factor into current plans or forecasts.
Okay. And one last check on those gross margins. Stable now, but how have they looked over, say, the last couple of years?
They mentioned margins have generally been pretty stable in the 21% to 23% range recently.
So this quarter fits right in that historical band, especially after adjusting for the one-offs last year.
Correct. Normalized margins are pretty consistent year over year, and they also noted that some of the intense cost pressures on trades and labor that spiked post-COVID have eased off.
Which helps support that margin stability. Makes sense.
Yeah.
Okay, now for something a bit different. This is not financial advice.
Definitely not. Just some creative thinking.
All right, so you've got Forestar, huge relationship with the Dr. Horton, aiming for even more of Horton's business in a tight lot market. Here's a wild idea for you to ponder.
Let's hear it.
Go long Forestar stock, standard enough. But here's the twist. Pair it with a simultaneous short position in, get this, a major lumber ETF.
Short lumber. Okay, unpack the logic there. That sounds unconventional.
Bear with me. The thinking is, if Forestar keeps executing, growing its Horton share, delivering lots, its stock should perform well, even if the broader housing market is just okay. That's your potential upside.
Right. Betting on company-specific execution.
Exactly. But if the whole housing market does take a significant nosedive, what happens? New construction probably slows way down, right?
Yeah, demand for building materials would likely fall.
Including lumber. So a drop in lumber prices, benefiting your short lumber ETF position, could potentially help offset some of the losses on your Forestar long if the whole sector tanks.
So trying to hedge sector risk by shorting a key input commodity, it's creative.
Creative, yes. Outrageous. Maybe. Plausible. Possibly. But look, this is super complex. The correlation isn't perfect. Shorting ETFs has its own risks, costs involved.
Big time risks. Transaction costs, margin calls if lumber spikes unexpectedly.
Absolutely. So this is purely a thought experiment. Do not attempt this without serious homework, understanding all the mechanics, and making sure it fits your specific risk profile and goals. It is absolutely not a recommendation.
Couldn't stress that enough. Fascinating idea, but definitely speculative. Okay, so that wraps up our deep dive into the Forestar earnings call.
Yeah, we tried to hit the key numbers, the strategy, the outlook, and hopefully give you a clear picture.
What stood out most to you as you listened? Anything particularly surprising or interesting from their commentary?
Always good to reflect. And remember, this is just our breakdown of one company's call. It's a snapshot in time.
Absolutely. You always need to do your own thorough research, consider your own financial situation, your goals, before making any investment decisions based on this stuff.
Definitely. Thanks for tuning in to TalkTickers. We'll be back soon with another earnings call breakdown, trying to cut through the jargon for you.